Welcome to the next podcast for the Multifamily Investor Nation. With us today is Arn Cenedella, all the way from Greenville, South Carolina. Arn, welcome to the podcast.
Great, Dan. Thanks so much for having me on. Look forward to chatting with you as always.
Yes, absolutely. And this particular acquisition is the Carolina Commons, 43 units, purchase price right around $65K a door. Looking forward to diving into this one. But before we do, why don't you share with the listeners and the audience a little bit about yourself and your background and kind of where you are right now in the multifamily space?
Sure. So I got into the real estate business in 1978. So that's 43 years ago. Was a residential broker for most of my career in Silicon Valley. Moved to Greenville, South Carolina, 2014. And a chance phone call with an investor buddy here in Greenville in March 2020 kind of got me onto the multifamily asset class. And since that time, I've kind of dived deep, educated myself, transitioned a lot of my own rental portfolio into multifamily assets, and have now completed 3 syndication deals. So excited about my progress and interested to learn more about the multifamily business.
Awesome. Well, without further ado, let's go ahead and dive into this acquisition, this 43 units called Carolina Commons. Why don't you first tell us a little bit about how you found this deal, how you sourced it?
Sure. Basically, I had developed a relationship with a local broker probably over a period of 18 to 24 months. Went to lunch with him a couple times. He, over that period, probably showed me 4 or 5 different assets, made offers on 1 or 2 of them, didn't quite get it together. And in late February of this year, the broker brought me this deal. I think he gave me first crack at it, which I appreciated. And within a matter of a week, we were in contract.
Were there any other bidders at play at this point in the deal?
As far as I know, there were not. At one point, my initial LOI was a tad below the asking price. And they kind of laughed and said, well, we'll go to market, and went back to my underwriting, talked to my partner. We liked the deal. And so I agreed to their list price. So I don't believe they shopped it to anybody else, but I can't be certain.
Okay. And so the final purchase price on this one was $2.795 million. And what was that their asking price?
That was their asking price, yes.
Okay. And how much below that did you end up offering on the first round?
I came in at 2.7.
Okay. So took off just about $100,000 off of there.
Correct.
It's not too crazy. And obviously they're probably looking at this going, that's not like that shouldn't have a major change in the economics of this deal. It's $100,000 on that size of a deal. So that's probably why they chuckled a little bit. You came in 100 over or 100 under just a little bit there.
Correct.
I want to first, before we dive into this a little bit deeper, talk to me a little about the broker. It seems like being 43 units, this might not be an actual multifamily broker. So talk to us about who this broker is. What are the types of assets that they usually kind of go after or acquire? Is it multifamily, single family, residential, or not residential, but single family residential or commercial?
Sure. So good question. And they don't really identify themselves as a broker. They consider themselves more investment advisors as well as being debt brokers. And they seem to handle a variety of commercial properties, including industrial, retail, and multifamily. So no single family. So they're strictly a commercial shop, and primarily focused, I would say, in the Carolinas. And most of the deals they brought me were kind of 2, 3, 4 million, maybe even as low as 1 million. So I would suspect most of their deal flow is probably in that maybe $1 to $6-7 million range, maybe similar to like kind of what Marcus and Millichap does and specializes in. So I'd say smaller commercial properties located in the Carolinas.
And how did you first get introduced to that group?
I've been trying to think about that. Somehow there was a deal in Spartanburg I heard about, and that led me to connection to these folks. But I'm a little fuzzy on exactly how it happened. But I remember a phone call about the property in Spartanburg, which was 15 duplexes. At the end of the day, it didn't work. The owner had yield maintenance, and there just wasn't any way to kind of put the thing together. And I think the next day we had lunch with 2 or 3 of his associates at my favorite place. And you'll be happy to know I did eat a burger. So I'll get that on record for you, Dan. That's an inside joke, folks. Yeah, that's how it is. And they're local, and that's kind of where I'm looking. So I think we've developed a nice relationship. And of course, I would pester them without trying to be obnoxious. And, every couple of weeks I'd touch base with them. Hey, do you got anything for me? Can you find something? I'm still looking. And I think that's critical. You just got to keep kind of top of mind with the folks in the space, brokers, investment advisors, whatever you'd like to call them. I think it's important that you try to keep top of mind with them and touch base, reach out to them, and so forth.
Now, how long after you heard about this deal did you actually go and tour it? And did you tour it before you got it under contract, or did you get it under contract first and then tour it?
We toured the property probably 2 or 3 days after hearing about it. And then I would say within a day or so after that. And when I say tour, we saw 2 of the vacant units out of the 43. So we toured it. Then probably within 24 to 48 hours, we were in contract and the clock started ticking.
And with the amount of kind of, debt that you have within the Greenville, South Carolina market, had you already known about this asset before it actually came available?
I honestly did not, Dan. I hate to say that, but I was not aware of this asset. So it was new to me.
Okay. And this obviously is built in 2006. Now, we've gone through, we got the offer, gone through the offers back and forth, finally settled on a purchase price. Now you've gotten through the contract, got the PSA signed, and now we're inside of this due diligence phase. Can you think of anything, or was there anything that came up during due diligence that might be interesting for us to talk about?
Sure. So we did thorough due diligence, roof inspections. We snaked all 43 sewer lines because each property is separately watered, water meter and so forth have their own sewer lines. I had a civil engineer out to look at the retention pond and the overall complex drainage. And since it was 2006 build, everything was pretty ship shape. The thing that became the biggest issue was CoStar had the units listed as 763 square feet. And when I initially toured it, I go, I don't think those are 763 square foot units. So during the due diligence, I bought my tape measure and I measured the unit myself, and it came out to be about 611. So that caused me a little bit of concern. Fortunately, my partner, Brian, talked me off the ledge. He goes, look, they're good 1-bedroom units. The floor plans work. At the end of the day, the square footage isn't maybe that critical. So during the due diligence, the big issue that I had to get over was the incorrect information in CoStar versus the actual size of the units.
So was the broker kind of, pitching you as it being 763 because that's what was in CoStar?
The rent roll that I received, I believe, did have the 763 square foot on the Excel document. Yes.
Okay.
But I can't say he made a big point about that. More, it was just described as 1-bedroom units which they were 1-bedroom units.
Yeah, and they probably, like you said, like everybody else did, just pulled it off a CoStar, just trusted whatever they saw.
Yes. I don't think there was anything dishonest or underhanded about it. You know, computers are great, spreadsheets are great. It's just once you get some data in, it just kind of populates throughout the world. And it was fine. They're good units, and I worked through it. Yeah.
So walk us through the business plan on this property. What's the plan? Obviously, this is a 2006 build, so it's not too old. So it probably got some good bones to it. But what's the plan to renovate these units?
Sure. And the 2006 build was a big part of it. Much of the Greenville multifamily stock, say in this sub 100 unit price, if you could even find sub 100 unit prices anymore, they're 1970s built. They're 50 years old, and you're dealing with all sorts of stuff. So 2006 build, 1-story units. So primarily our business plan is interior renovations of the units, LVP, upgrade the appliances, kind of tune up the cabinets, new light and plumbing fixtures. The other big part of it was the units were built with washer dryer connections for stack washer dryer units. But the current owner was not providing washer dryer units. And I can tell you, in 43 years in real estate, I've never known a tenant to buy a stack washer dryer. You may get some tenants who have side by side and they take them from house to house to house, but I'd say typically apartment tenants don't buy their own washer dryer. So they did not provide washer dryers. So one of our value add plans is to provide stack washer dryers in the units. And that we figure we could probably get about a $50 rent bump. Full renovation of the units is about $7,000. Some of the units already had LVP down, and we've renovated 1 or 2 of those, and those more come to about $4,000 a unit. Average rent in the complex when we purchased it was $585. Happy to report we've rented 4 renovated units at $750, and we have a waiting list of 4 other people. The next batch will go out at $795. So I would call it kind of a down the fairway, light cosmetic value add, which really appeal to me as being a relatively new operator. You know, my property manager, my partner, and I, we've all renovated houses and units. And so this didn't really call for anything different than what we've done for years.
And what's the feel of this community? It seems like if they're all kind of single story, you know, 1 bedroom, 1 bath type units, it seems like a little more of a kind of almost like a single family residential type community feel.
Yes, precisely. There's, I think, 9 buildings. So each building maybe has 4, 5, or 6 units. I believe there's, I want to say 5 acres of land. They probably have close to 100 parking spots. So they have over 2 spots per unit. So yes, it's kind of a very peaceful single family type environment. Nobody living above you. It's spread out. There's plenty of parking. There's plenty of open space. There's 1 driveway in, and then it kind of loops around off one of Greenville's major streets, but you're kind of tucked back there, so it's quiet. So I think the complex is very, very appealing, kind of white vinyl exteriors, which we've power washed. We're going to paint all the exterior doors kind of this seafoam turquoise blue. So it's an attractive complex, but we're going to make it better. And I would say many people may rent this as their step before they go buy a house. You know, it kind of has that feel. So yes, it's kind of, we call them the cottages at Staunton Bridge. We've renamed the complex because the little bungalows are basically like little cottages.
What are you doing for property management on this asset?
We stuck with the prior property management company. My partner, Brian, is a residential property manager in Greenville, probably manages over 350 units. Very good, runs the renovation crews top notch. He manages my properties. We got Freddie small balance loan on this deal, and Freddie wanted us to stick with a multifamily property manager. So we've elected to stay with the property manager that's in place. Of course, having a property manager as an owner helps keep the existing property manager on their toes. Brian's crew handles the renovation, so we're doing the unit turns, not the property manager. And essentially it takes us maybe 3 working days to turn a unit. So we're pretty good about getting them turned.
How's the supply chain right now?
The supply chain has been okay. We had a scramble to get stack washer dryers. So we had to put in a few calls. The flooring doesn't seem to be any trouble. The paint hasn't been any trouble, though I know some people have had trouble getting paint. We're not doing anything with the cabinets. The windows are already dual pane. So far, it's been fine. The way Brian has it set up, he's got a package with his supplier, and he just calls him up and says, hey, we need 2 sets for the cottages. His guys pick them up 6:30 the next morning, and away we go. So we've kind of got a system. All the units are identical. So we got 43 identical units. So the rehab and the turns work very efficiently.
On the stack washer and dryers, what are you getting those for?
I would say, I think we're at $11.50.
I know they're pretty expensive.
We debated whether to lease them all from a company, and some operators do that. And I think that could be a solution if you had 43 installs you all wanted to do at once. In this case, since we're renovating unit by unit as they come vacant, we felt buying them was the better option.
Yeah, I mean, you're definitely increasing the value of the property too. I mean, I don't know what your cap rate was going in. What was the going in cap rate?
Going in cap rate adjusted for increase in property taxes and about a 50% increase in insurance was 5.2. So okay. It was T12, but we adjusted for property taxes. In South Carolina, it's what do you call it? Reassessment upon sale state. So you really got to know what you're doing there. And we anticipated insurance costs might go up about 50%, and that's about what they did. So 5.2 entry.
Yeah. So if we do this math real quick, $50 a rent bump times 12, right? Which is the 12 months of rent bumps. And then multiply that 600 by 43, we're getting 43, excuse me, let me just do math real quick. 12 times 50 times 43, we're at 25,800, an increase in income. Divide that by the cap rate, we're now an increase of almost $500,000 in value of the property just by spending, what is it, like maybe $50,000.
50,000, yes. Yeah. It in our mind, it was kind of a no-brainer. And it's very interesting because the people who owned it, and I mean no offense to that, are more spreadsheet financial guys, if that makes sense, where Brian and I are kind of more come from the single family operator space. And so I think there's some advantages just kind of feeling kind of what people need where maybe the financial spreadsheet types don't have as much nut and bolt experience to kind of feel, because for us, I mean, who wants to sit in a laundromat? And I don't even know, what does it cost today? $2-3 a load to do a load of laundry. I mean, it's, plus you're sitting there an hour. I mean, to me, that's such a quality of life bump. We estimate we bumped rent maybe $50. There's no way to quantify it because we're rehabbing units as we go. So part of the bump is the washer dryer, but in our mind, it was kind of a no-brainer.
Yeah. I mean, I think any resident would look at that and say, it makes sense, you know? I mean, to me, it's a great value add for that particular asset.
Well, thank you.
So you mentioned the Freddie SBL on this one. Let's talk a little bit more about the financing and walk us through some of the terms you got.
Sure. So let me first say, getting a Freddie loan was a real experience. Okay. So for those of you who
welcome
are
to the club, Arn.
Yes, no, I know you just put about a 10x or 20x on front of it. But so I borrowed a lot of money in my real estate career, but getting a Freddie loan was kind of a total new experience. And at one point, they were trying to underwrite a $15,000 a year payroll expense into their NOI. And of course, there's no payroll. We don't have anybody on site. And you know, 15,000 on the NOI for a $2 or $3 million deal, you're talking a big difference in loan proceeds. So we had to battle through that, but the debt broker, who was also the guy who brought me the deal, we worked it out. We ended up getting 70% LTV, which is about what we were always shooting for. And we took a 7-year note, 1-year IO. We got step down prepay, which I really wanted. And our rate was 3.86.
That's not bad for a Freddie SBL.
Hey, I paid 11 3/4 for my first house. Okay. So now I'm borrowing money at 3.86. So it looks good. And what was also fascinating is, and you know, but perhaps this will help your audience, Freddie kind of has a matrix where as you go from yield maintenance to step down, or what kind of step down you want, the rate changes a little bit. As the term of the loan changes, the rate changes a little bit. The debt coverage ratios change depending how many years of IO. So there's kind of a entire matrix, and you're kind of trying to weigh and balance these things to what was best. Initially, we went in trying to get 2 years IO. Ultimately, we were okay with 1, especially because we got the step down. But 2, we felt so confident in this property. We knew within 12 to 18 months we could get the rents to where they are. In 2 months of ownership, we've already increased the rent roll about $1,000, and there's just more to come. And so we felt okay, 1 year IO to kind of get us in the door. And by the year 2, when it starts amortizing, our income will be up and we'll be fine.
That's good. That was going to be my only comment about the debt is the 1 year of IO, but it seems like you already tried to maybe go to bat, try to get the 2 years or more, but it just didn't work out.
Yeah, and what I think would have happened, and again, I'm no expert. This is my only first trip down this lane, and I'll be smarter and better next time. Though the debt broker was great, and I think they did a great job. I think what would have happened if we would have gone 2 years IO, the loan proceeds would have dropped. And so we kind of weighed that. As it is, we probably raised 100,000 more than we needed. But both Brian and I really believe in having sufficient capital reserves. It secures the deal. It secures the investors. Yes, the returns may be a tad smaller, but we really wanted to go into this deal well capitalized. And since it's a newer project, we're probably going to be okay. And I think our plan is once we get into it 6, 12, 18 months, maybe we start returning a little capital early if we find we have too much. We did have to put up 12 months P&I for COVID reserves. And of course, we closed mid-May. And I think by the end of May, Freddie got rid of most of their COVID reserves, if I remember. So we ended up giving 12 months of COVID reserves.
Well, and you might be able to get that back. So we've gotten it back on all of our assets so far, except for one. And we're waiting on that one.
Yeah, I will get on it. I think the note said we could ask for it back after a 15-month period. Okay. So I believe there was a stipulation in there. And so I don't really know now that they've kind of lifted that. Did that kill the 15-month stipulation or not? But
I would try for it. That's what we did, because we had 3 assets that we closed in the fall last year. And all 3 of those were same thing, 12 to 18 months. And we already have the money back on those. So
can I have you call them for me?
Well, Danny on our team is the one who handles that. So.
Okay, I'll have Danny call him then. Yeah. They'll shake in his boots. Yeah, that's good. Okay.
Well, let's move into the investor talk here a little bit, because I know you brought that up already, a little bit about the returns for investors and various things like that. So first, talk about how did you end up structuring this deal with your investors?
Sure. So that was a whole interesting thing. You try to figure out how the property is going to perform, and then you figure out how does the general partner get fairly compensated while still paying a good return to their investors. So to start at the end, basically over the 6-7 year hold, the LP should get internal rate of return 13 to 13.5, with an average cash on cash return of a little over 7. So that's kind of our target. And I think those are solid numbers given the market. And that was based on a 6% exit cap. So we came in at 5.2. We used 6% as an exit cap, which I think is a defensible position. In terms of the splits and the pref, we're offering a 6% pref. We started at an 85-15 split. At 10% IRR, it goes to 80-20. And at 13% IRR, it goes to 70-30. So we thought it was a solid deal, and we try to, receive ample compensation for doing it, but still kind of provided the returns that the LPs want. And I think we struck a decent medium there.
You basically have 3 hurdles in the waterfall there.
Yes.
Yeah, 3 hurdles in the waterfall. 6% pref. And now, does the pref have a catch-up, a GP catch-up with it, or is it a straight, true preferred return where 100% of the cash flows up to the 6% goes to the investors, and then you start the splits?
It's 100% of the cash flow goes to the investors. So The truth is, as the GP, we're not going to really hit the waterfall until disposition. Okay. Pretty much, in broad pictures. So basically all the cash flow less the asset management fee goes to the LPs. Okay.
All right. And what was the fee structure on this one?
2% acquisition fee, 3% asset management fee, 1% disposition fee.
Okay. Pretty standard. I like it.
Yeah, try to be reasonable.
Sure. No, yeah. I mean, I think I probably would have gone a little bit higher on the acquisition fee because it is a smaller deal, but 2% is fine. 3% AM, maybe 3.5% is what I might have done on this one. 1% disposition fee, I probably would go to 2% just because our disposition fee, and I don't know how yours is structured, Arn, ours is always given as long as we hit a certain return. So as long as we hit a 13 IRR on most of our deals, we'll usually take that disposition fee, but we don't, a lot of groups will take it up front first, and then they'll pay the waterfall. And it just depends on where you take it as to what size of fee you might want to put in there. So
good advice. And it's interesting. We needed, Brian and I had the net worth to qualify for this loan, but we didn't have the agency debt experience. So have a mentor of mine as KP. And when we first brought the deal to him, we had the acquisition fee at 1%. And as he was going through the spreadsheet, he just crossed it out and said no 2. So that's what we went with. But I appreciate your comments that on a smaller deal, they could be a little bit higher. And, for me, this is the first real true syndication deal. Brian and I want to do a great job for our investors. This isn't going to be the only deal. And so if we erred at all, I think we try to err on being more than fair with our limited partner investors who we want to. I can tell you, we closed May 13th. Several of them are already saying, when's the next deal? So, and we've talked about this before. It's kind of, you learn by getting in the game. And so I think it's important to get in the game, and that's where you really learn. And so I think this was a great, for a lot of reasons, we're very happy with the way this one is working.
And how much capital did you end up raising?
We ended up raising $1.5 million.
And that wasn't including the CapEx.
Including the CapEx and the COVID reserves. Yes.
And how did you go about raising that capital, right? Because 1.5 seems like a lot to many people, and then sometimes people look at that and go, oh, that's not that bad on a deal, but obviously BSP in one of your very first deals, it's obviously a big chunk to try to take down.
Great question. And to back up a second, you're never sure of your loan proceeds until a week before close or 10 days before close. So, that kind of enters in. Both Brian and I have developed good professional relationships. And so most of our investors already knew us. We ended up having 30 investors, $1.5 million. We had a $25,000 minimum. Again, to allow people who are maybe new to the syndication space just to kind of get in. And it's kind of interesting. We had 2 or 3 people come in with very large amounts. We had 3 or 4 kind of come in at the 50 range. And then we had a batch, probably over half at about 25,000. So we ended up with 30, which would average to 50. But I guess the mean would have been more like 25. So most of these were people that we already had prior contact with, though maybe 5 to 10 of the investors were kind of new people that we brought in with our outreach during the marketing. So we had a webinar, we put together an investment summary, and the fundraising came together fairly quickly.
Good.
Yeah.
Good. And what's your plan for managing these investors? I mean, obviously, some people look at this and they go, 30 investors in a deal, like that's a lot of work. So what is your plan to be able to manage these investors?
Okay. So I'll handle the investor relations. So the monthly emails is no problem. We've sent out 2, and that's my responsibility. My partner, Brian, uses Buildium as his property management software. And within Buildium, there is a way to connect it to ACH payments. So we've set it up in Buildium where each of our investors is kind of like a vendor, if that makes sense, like you would pay. And so Buildium will generate the ACH payments. We're going quarterly, so we have to do it 4 times a year. So we're using Buildium, which Brian's very familiar with, and what he uses to pay all his other property management clients. Mm-hmm. So we did, we investigated a portal. I wasn't sure we were quite ready for that. And ultimately, we just kind of decided to do it ourselves. So in terms of getting the PPM signed and all that, it was good old fashioned DocuSign, and I would send them out. And I do have a VA who helped with a lot of it, but basically we just kind of used brute force to get it out. And we'll certainly tune up our game as we go on, but we have to do more deals to do that, maybe.
Well, I will tell you that there's nothing wrong with good old DocuSign. So that's how we do it right now too. So.
You can template it, and the thing I love about DocuSign is you never lose a document. An organization is not my strong suit. Okay, so fortunately, Brian's OCD, so Brian's my Danny. Okay, so he keeps everything ship shape while we talk. So that's how it kind of works.
That's good. That's good. Well, can you think of any other issues or things that came out throughout this entire process on this acquisition that we haven't talked on yet that we could probably dive into a little deeper?
No, I'd say it went relatively smoothly. I would say for people who are entering this space, you're going to have some emotional ups and downs. And I know, like, one day I would be down and Brian would pick me up. And the next day, maybe Brian was down and I'd pick him up. So the other thing, I'm in my mid 60s, Brian's in his mid 40s, and about 3 days after close, Brian goes to me, because we closed on a Thursday. I talked to him Monday after. He goes, "Man, I'm exhausted." He goes, "I slept all Saturday." So the other thing I would just say is it takes a lot of effort to get these things done, and it's a lot of work. But what I would say, it's totally rewarding, and it just kind of whet our appetite to find another one. So that's kind of what I'm on now. Had a great KP, somebody that I developed a relationship over the last year, and his advice and counsel helped, and certainly his name recognition within the agency community helped. And they even kind of asked, why is this guy messing with such a small deal? And so we kind of went through. I just didn't pick him up out of the phone book and pay him. We had an existing relationship. So I think it's important to develop a relationship with one of your key principals ahead of time and build that relationship too.
Yes, totally agree. Totally agree. Well, that's great advice, Arn. Thank you so much for all the content during this episode. I know there's going to be a lot of value packed into this little short episode here. How can the listeners reach out to you if they have further questions for you about this acquisition, or they just want to continue to follow you more?
Well, thanks, Dan. So the name of my business is Spark Investment Group. Website is investwithspark.com. My email is Arn, A-R-N, at investwithspark.com, or my cell 650-575-6114. And love to talk real estate with anyone. So just reach out to me. I'll give you my honest opinion. Won't say I'm always right, but at least it'll be my honest opinion. Right? None of us are always right.
That's right. Well, thank you again so much, Arn. I appreciate the friendship. Appreciate you jumping on again and having another episode with us. And looking forward to continuing to follow you as you continue to close more deals, and wish you the very best.
Thanks, Dan. I look forward to coming back real soon.